Okay, so today, financial frenzy. Lecture 20. So the last lecture of our financial series, and this one is about when bankers go wild. So financial frenzy, bubble economics, and dysfunctional finance. Well, we talked about some other ways finance is dysfunctional, but in the current atmosphere, the most salient kind of dysfunction is clearly what happened leading up to the bubble of 2000, the crash of 2008, the bubble that peaked in housing in 2006, and that brought us to the Great Recession. So I'm going to talk about the logic of bubbles today. Oh, I forgot to do my tips. Oh well. I'm going to talk about the logic of bubbles, how they work, kind of fit it into our theory of cycles. So that's the first major point, that finance can blow up economic swings in the economy. But it raises a question about whether finance is autonomous or not, which is one that plagues all economic theory and plagues us as well today. How much can you restrict finance? We will then talk about the history of financial bubbles a bit, give you an idea that they've been around a long time, and are pretty regular occurrences, though regular in the sense of pretty long-term. And then finally we'll talk about the origins of the Great Recession and the recent financial bubble. And of course we'll touch on some things we've already touched on before, but hopefully amplify them. So we'll start off with the logic of bubbles, and I have four categories here: credit cycles, asset bubbles, financial follies, and implosions. So we'll start off with the idea that we have cycles, which we encountered back in lecture 4, that the capitalist economy has by its nature this tendency to accelerate into upswings and booms, and then hit certain walls that lead it, or problems that lead it into a recession or a crisis, however you want to put it. And we had graphs that looked like this before, showing swings around a trend line and so on. So we have these underlying swings of the real economy, where, as we saw before, you get a rise, you get movements in all the key indexes like sales, outputs, orders, employment, and of course profits, the key index. Now in Keynesian terms, which we didn't use back in lecture 4, the upswing would be profits are going up, or looking good, and prospects, always that outlook question, that mental problem, the business outlook is good, and this leads businesses to invest, to take that chance on the future that looks good. So that gets your eye up. And then as businesses invest, they hire workers. If the boom is good, they may pay them a premium in order to get the workers they want, so wages start to go up. So employment and wages go up, which means there's money in workers' pockets to spend, and consumer spending goes up. C. So I is up, and C is up. And finally, government spending goes up in booms, because revenues go up. As there's more economic activity, tax revenues increase with the same tax rate. Now, of course, we have talked about counter-cyclical government spending, but this is just the natural tendency is going to be for revenues to go up, because the government depends on the underlying economy for its tax revenues. And then if the government is spending, as it tends to do, as things improve, and you've got the possibility of expanding programs, and so on, up goes G. So we've got C plus G plus I is expanding, and then we get those Keynesian multiplier effects, and also the Keynesian sense of optimism that he always thought was very important for the animal spirits, as he called it, of the businesses. And you've got these polls, all these business polls about consumer outlook, business outlook, how are we feeling? Which is exactly that. And of course, the feelings run very much in tandem with the underlying realities, because people aren't stupid. But they amplify those realities. And I think that's important, that everybody's feeling good about a good economy. You're more likely to take that bet on the investment. And when things are not going well, you're less likely to. And then we saw that you get overshoot. You get, as the boom builds up, the system overshoots its ability to sustain a certain very high growth path. I mean, if this is your trend line here, and you're going up like this, you're going to overshoot that trend. And that trend may very well represent what your economy really can sustain. So you overshoot kind of sustained growth, and you start to get those supply bottlenecks. Maybe wages start to pinch profits, or suppliers, resources start to pinch profits, or whatever. And also, because everybody's been investing, you get overaccumulation, you get too much capacity, too many products, markets start to glut, prices start to fall. And so then you get falling profits, and then output, they cut back on output, they cut back on employment, start to lay people off, wages start to sag as labor markets saturate, and so on. And then that all becomes self-reinforcing too, and you get a downswing. Now recession's generally a little shorter than upswings, because on the whole, capitalism's been growing, so you'd expect that. Okay, so that's the stuff we already talked about. Now, what if we had credit? Okay, we talked about credit and money supply. So we get credit expansion in the boom. As businesses invest, they often borrow to invest. So they're starting to get lines of credit from the banks. And then households are feeling better. They've got their wages are going up, and they say, well, now's the time to buy that house. Now's the time to buy that new car. I don't actually have the money right now, but I can get a line of credit from the bank. And indeed, banks are feeling bushy-tailed, because they're starting to lend more. They're getting repayments. People are depositing more money, more transactions that they make money fees off of. And so they're lending more. They're feeling good too. As banks lend more, the money supply grows. And as the money supply grows, if it grows rapidly enough vis-a-vis the overall growth of the economy, interest rates are likely to fall as money supply goes up. And then everybody's feeling optimistic, and off we go. Same thing in a recession, except in reverse. The credit starts to shrink. So a company's getting into trouble. Their products aren't selling. Suddenly they have a cash flow problem. The products aren't jumping off the shelves. They have cash flow problem. They have problems paying their suppliers, paying their bank loans. They have to delay those payments, or they miss payments. That's what happens. Then that makes everybody who's extended that kind of commercial credit or bank credit feel much more nervous. And so they stop lending. They stop extending the credit as easily. And the whole thing, the credit shrinks. And then the money supply shrinks, which may indeed drive up interest rates. Interest rates often go up in a crisis, which is why monetary policy is usually aimed at lowering interest rates to help overcome that effect, to stimulate the economy to grow again. We'll see that with what Greenspan did in the 90s and again in the 2000s, was drop interest rates to stimulate the economy. So then there's the general pessimism. So we've added credit, and we see that we get the cycles can be amplified by that. Then we want to add the fact that we know that financiers have an interest in making money on this cycle, making money in good times. And so financiers have a positive interest in promoting credit creation, borrowing and lending during good times. They are feeling good, that it's their competitive interest to get those loans out, to find the businesses who want loans or the consumers, and they start to loosen their terms. They want to make loans. They're feeling good. They start to not maybe look at your credit rating as tightly as they did before, not look at your income as tightly as they did before, as closely, and so on. Similarly, in downturns, banks pull back, lenders pull back. And that goes for commercial credit, by the way, too, between businesses. But we're mostly trying to talk about formal use of financial credit from the financial sector. Okay, so we know that today in the Great Recession, the banks have been very hesitant about lending because they're not sure there's a lot of good loan opportunities out there. There's a lot of really credit-worthy borrowers. So, here's just something I pulled right off the web about commercial borrowing, banking assets, and total loans. And you can see that lending by banks goes up and down with these short-run business cycles. This goes back to 1950 to 2010. You can see it dropped like a stone after 2008, but there it is dropping in the recession of 2000, dropping in the early 90s, dropping in the early 80s, and conversely, during the boom of the 80s, there you get a growth of credit. So credit is cyclical too. Okay, now let's add another element, asset bubbles. Assets, we talk about assets as these paper claims that are stocks and bonds and other kinds of claims on income flows out of the national income. Okay, but along with the claims are the asset prices. So these assets circulate in capital markets, stock markets, bond markets, and they get a price. And as the price goes up, the asset becomes more valuable. Now, there are interesting questions about bond prices versus interest rates and all that we won't go into. But asset prices also go up and down in cycles. This is a stock market measure, DJI. I can't remember what that is. Oh, it is Dow Jones. Okay, thank you. That was obvious. Okay, so there's Dow Jones going back to 1890. You can see it has a lot of little wiggles. It also has some spectacular big ones we'll get back to. But it has lots of little wiggles, so the stock market goes up and down. Bond markets go up and down. Now, an asset cycle is when investors start to put money into assets in search of price gains. Okay, they aren't just buying the asset to get the dividends, to get the interest from the bonds, the dividends from the stock, which is your very patient kind of investment. But this is your more rapid-fire investment. I'm going to make some money off rising stock prices. Well, as you know, that's what most people invest in the stock market for. Not everybody, by the way. But that's what an awful lot of people do. And when things are good, investors jump in because they want to get the price gains as the stocks go up. And then you get a self-reinforcing phenomenon that's called herd effects, as in H-E-R-D, or bandwagon effects. I kind of like bandwagon better. So you want to get on the bandwagon. You want to get on the stock market while it's rising. You don't want to wait too long. It might peak. Or you might miss a lot of gains if you don't get in there while it's still rising. So everybody jumps in. And then because other people are making money that way, and they see that, your friends, your fellow companies, you're talking about the brokers down at the office that are talking to each other, who's making money, they're throwing money in here to try and make money on money. And what you get, of course, is ultimately the same kind of overaccumulation, which shows up as overvalued assets. Too much money has gone into paper assets. They're not really worth that much in terms of their actual returns, their dividends or interest. And you get a very standard measure, and there are many measures. Standard one in stocks is the price versus earnings ratio. Now, that can be a normal ratio is something like maybe 10 to 1 or maybe less, 5 to 1. I forget what a good ratio is. But you get ratios during bubbles that go up to like 30 to 1. Yeah. Oh, nota bene. That means look out. Note well. Sorry, it's just a little English thing. Shorthand. So, and it's easy when you look at a stock market chart like this. This is 100 years of stock market. I think that's 1929. I'm pretty sure it is. And the collapse. You look at nominal prices. And it's easy to get on these bandwagons because nominal prices are going up. Everybody's going, wow, that's terrific. But if you look at this one, which is in constant dollars, you see that the rise is not as great. The rise, these are more variations from trend, whereas this just like, woo, up and up and up and up. Well, but investors are often taken in by nominal prices, just as workers are taken in by nominal wages, and there's whole literature in economics about this. Whereas real prices, real gains in the stock market may actually be going up much more slowly vis-a-vis inflation than you think. But that gets everybody enthusiastic too. Anyway, you end up with overvalued assets that aren't ever going to return. And when enough people realize that, that's when they jump off the bandwagon and get out. And of course, the trick in investing, speculative investing, is to get in and get out while it's still going up. But it's very hard because, well, if I wait a little longer, it'll go up a little more. So here we got a financial forcing part 2. That is in the asset realm. The financiers love to jump on these asset bandwagons and, whip them. So I guess if it's a bandwagon with horses, they're up there beating on the horses, got to go faster. So they do, and they do all kinds of things. One of the things we saw, of course, in spades in the last 30 years is inventing new instruments, inventing derivatives, inventing CDOs and CDSs, and all these new instruments that you can invest in to suck investors in. Come on, this is a really hot new field. Get in on the exchange-traded funds. Whoa, and everybody jumps on that one. Oh, yeah, I'm cool. I'm ahead of the game. And when you're really ahead of the game, you can make some money. But then everybody gets in and nobody's making money. And then the bankers and the traders are often the first to get filthy rich in these bubbles. So they get their bonuses. They get inside trading, and they're using their knowledge for a little investment on the side or to help their favored investors make a lot of money. And sometimes the banks or the investors, as we saw in the last bubble, get in there and start speculating in assets themselves, which is really dangerous because they're supposed to be these financiers. Remember, supposed to be our overseers. They're supposed to be sober, restraining capitalists from bad investments. But indeed, if they start jumping in, then they're actually committed. And we saw this weird stuff that went on in the bubble, like Goldman Sachs doing things like betting against its own advice once it thought that the housing market would collapse, because they were also invested. And a lot of the big banks got in trouble, had off the books what were called special investment vehicles, where they were investing in the crap that they were inventing. And that turned out to be a really, really bad practice. The other thing they do, especially banks, is to lend to investors who aren't investing in factories, but are investing in stocks, investing in assets. Yeah, but this could go for insurance companies lending to REITs, investing in properties during a real estate bubble, too. It's not just banks. So you get people then start playing the stock market on what's called on margin. And that's when you know you're really in trouble, is when a lot of people playing the market, not just little specialists and risk takers, but a lot of people are borrowing in order to play the asset bubble game. Because then they're using other people's money. They're even more wild and free. It really becomes spring break. And then everybody feels wealthier because in an asset bubble, as the wealth holders are in there, they're all feeling wealthier. Now, if it's homeowners were all feeling wealthier in the 2000s. They say, well, my house is suddenly worth, this house I bought for $250,000 is now worth $500,000. Man, I am set. And everybody feels wealthier, even though it turned out when the bubble collapsed, it really was only worth $250,000. Okay, but everybody feels richer. So what does that make them do? Oh, I think I'll borrow some more. I think I'll borrow against my house. I think I'll borrow some more, or I'll take some of this loot of mine and I'll speculate some more in stock markets. Or maybe even real investment. Actually, in the 90s, you got real investment out of people who felt this wealth effect, companies that felt the wealth effect. And then, of course, financiers have an interest in promoting the whole ideology of getting rich quick through purely financial gains. which of course ultimately can't be sustained because they have to represent a reasonable payback on the functions of finance to the real economy. And if that financial values are running out of all connection to the real economy, how are they going to get paid back? Well, they're either not, or they're going to be screwing the real economy. But mostly you get this delusion, and everybody starts to believe, as they did in the 90s and the 2000s, that this will go on forever. And that easy money is the easiest, this is the greatest thing in the world. And everybody jumps on the bandwagon. And there's a lot of this ideology. This is just a Business Week bestseller. There were these books that came out in the 90s called Dow 30,000. Has the Dow made it to 30,000? Not even close. Okay? That's really, we're trying to sell investors on the idea the Dow is just going to go on forever. And there's just no stopping this train, except the train ran off the tracks. The other thing the bankers do and financiers do is they work to actually weaken the regulations on finance during the bubble when they can convince government people and politicians that all's well. And we also saw that. The deregulation during the bubbles of the 90s and the 2000s and even before were partly, of course, just self-interested scammers. But also, it's just like everybody felt, this is great. Derivatives can never go wrong. Why regulate them? You're just harnessing this wonderful force of the market. Oh, it's going to carry us all forward. Oops. And we saw when Sidney Mintz was an old economist, came out of Berkeley years and years ago, is now passed away, but who wrote a lot about how these financial speculators could drive the markets. And he kind of came back in vogue after 2008. A lot of books written citing Sidney Mintz. He also had some other very good followers over the years. And then there was Paul Sweezy and Harry Magdal from Monthly Review that used to make this argument for years. That the self-interest of finance was to create bubbles. And of course, bubbles eventually overshoot. Bubbles create even worse overaccumulation. Because the investor's even more optimistic and they can get easy credit, they're overinvesting and create even more capacity and potential glut. Even more firms, even more debt load that you have to pay off. We'll go into debt. No problem, right? And it's just, whether it's student loans or it's corporate loans, if things are going great, everybody says, I got a great job, I'll pay it off. Then when the crash comes, you realize you're not going to get that job and you aren't going to pay it off. And then all of a sudden, the student loans look like a bad bet. Okay, financial follies. What am I going on here? Why do we get really big bubbles like the one we just had? That's kind of the mystery. Because every little cycle doesn't produce big financial cycles. So if we look at these kind of charts, this one goes back to 1900, this one goes back to 1950, but it's clearer. Can't always find the chart you want on the web. This one's pretty messy, but it does show there was a stocks were pretty high in 1900 and then went down to 1921, then shot up in the 20s, collapsed, little blip in the 30s, but then you see they're pretty low through here, and it isn't until after the war they start their rise up to a bubble, a kind of bubble, although it wasn't felt as a huge bubble, in the early 70s, then that collapses, and then they take off again in the 80s, and off we go to the greatest bubble of all time. And these, by the way, are PE over E ratios and other things that are going amiss. This is actually another index. This is a P over E ratio too. And this one's just from 1950 showing the rise up to the late 60s, early 70s, and then it goes back down, then it comes up to this other bubble. It peaks actually peaks in stocks in 2000. Because the big bubble in stocks happens in 2000. The housing bubble follows on that. We'll come back to that. Okay? So financial bubbles, if you look at these kind of charts, look like they happen maybe every 25 years. Other people say, well, this was the biggest since 1929. So maybe they only happen once a century. But they actually seem to happen. It's more like 25 to 50 years you get these major ones. And this one is pretty good, but people didn't really notice it that much, although I'll come back to it. This one everybody noticed. There are two theories on why you get long-term financial frenzies. And the first theory is that it's the fault of finance. That basically finance takes over and it starts to run amok. The financiers get their grip, get their claws or their jaws onto the neck of the real economy. They corrupt the system by forcing through, and paying off politicians to get deregulation so that they can make a lot of money. Then people rush in there. Everybody gets on the bandwagon. Everybody sees an interest in finance. And we all lose our collective heads. And that's that could be Sidney Mintz. Kevin Phillips in his book Bad Money came out 3-4 years ago. It's not George Stiglitz. Isn't it Joseph Stiglitz? Yeah, there's an older Chicago economist, George Stiglitz. I'm sorry about that. That's not terrible. He was very conservative. He was one of Milton Friedman's buddies. And they've argued this kind of argument that we let finance get out of control. If we simply re-regulate it, everything will be fine. And indeed, there's all kinds of signs of that kind of finance. This is finance as a percentage of market capitalization of all American firms going back to 26. Yeah. And you can see, of course, this looks so small because this is so high, so you can't really see the 20s very well. And then it's pretty flat until 1970, and then it steadily goes up with these huge peaks along the way up here. But it's obviously kind of, this is very strange, the way it just takes off here. Here's another one I think I've shown you before about financial profits as a share of all profits getting up near 30%. And here's a cartoon, because it's always good to have a cartoon. There's no correlation with stock prices, it's just a feel-good graph. And then everybody, then everybody forgets. The 1929 is a long time ago. Everybody forgets. Everybody says it can't happen again. Indeed, it does happen again. So we get far enough away from the last mega bubble that, all restraint is lost and people just don't get it. It's kind of like natural hazard theory that, we forget about the earthquake and we all go about our business, but the next one's coming. And then we go, oh, well, that was a surprise, and so on. The second theory is that it has more to do with the real economy, that the real economy is actually stagnating. And this is associated with Robert Brenner, or a longer version who's written about the last 50 years, and a longer version, Giovanni Arrighi, who died recently, who looks at 300 years, although the book's called The Long 20th Century. He actually looks at 300 years and argues that every century you've got the rise of a major power, the Dutch and then the English and then the Americans, and after a while so much surplus builds up, and they don't know what to do with it anymore. And then for various reasons, the dynamism of the economy starts to fade. The economy isn't growing very fast. You've got all this money you don't know what to do with, and you just start throwing it around in the financial sector. It's because there's a lack of outlets for investment. And capital shifts into finance. It doesn't know what to do.